Claudio. Let me build on the previous two presentations by outlining three research themes that have guided our work. The annual report reflects these three research themes, but let me go somewhat further in this presentation to give you a sense of the type of questions that have guided our work. The first theme is the characteristics of financial intermediation. This theme deals with questions such as what determines the balance between intermediation through the banking sector and through the capital markets, what determines the motivation of the market participants, how do their actions affect the market outcomes, and in turn, how do the market outcomes also affect their actions. And what we gain from these questions form the building blocks to, of course, larger questions. And if there is a motto, the prescription is to know your players. I think this turns out to be quite important, as you'll see. The second theme is global liquidity and spillovers, which addresses the cross-border transmission of financial conditions. As you'll see, knowing your players turns out to be really very important for this theme. The first phase of global liquidity is about banks, and the second phase is very much about capital markets. The third theme is monetary and financial stability policy frameworks. And here, the common link is going to turn out to be the risk-taking channel of monetary policy. And the idea is that monetary policy, at least in part, operates through fluctuations in the risk premium. And so monetary policy and financial stability turn out to be not separate issues, but actually just the two sides of the same coin. And so we really have to understand these two together. Now, this chart is from the annual report, and it's a retrospective on the events of 1994. In 1994, as you remember, the Federal Reserve was raising the Fed funds rate, as shown by this upward-sloping arrow. But in the meanwhile, France and Germany were lowering their policy rates, as shown by this downward-sloping arrow. But nevertheless, the 10-year sovereign yields of all three countries was rising in lockstep, as shown by this upward-sloping arrow. And arguably, this is a picture of US monetary policy affecting European long rates. Now, what's happened recently? So here's the relevant chart for the recent experience. What's notable in recent months is that the direction of spillovers arguably has gone in the other direction. As both Hyun and Claudio have mentioned, euro area long rates have fallen a long way and very rapidly in 2014 and earlier into this year. And notice how the red line, which is the US 10-year rate, notice how that's actually followed the European long rates. The dotted line here shows our computed risk, the term premium, extracting the actuarially fair rates. And you see that the US term premium has very much followed the European term premium. And the recent fluctuations, the recent snapback has also pretty much proceeded together, as you see in this chart. Now, it remains to be seen whether the traditional direction of causation, which is from the US to elsewhere, will be resumed as we enter Fed liftoff. But this is certainly something that we will be keeping a very close eye on. Now, what explains these very close, apparently co-movements of long rates across countries? We know that this is a very well-established empirical feature. And in particular, what actually determines what was behind this very rapid fall in the term premium in Europe in particular? I think one, we can get some insights into how long rates behave by looking at this chart. And here we benefited a lot from some data on the German insurance sector provided by the Bundesbank. And this shows the maturity profile of government bond holdings of the German insurance sector. And this is a broad basket of government bonds, advanced economy government bonds. The bar charts here, the bars indicate the proportion of the total OECD government bond holding into these maturity buckets. And you see that the peak is the 10 to 20 year bucket. This is the end. This was the picture at the end of 2013. If we move the clock forward 1 year, we see that the deep red bars, which is the picture at the end of 2014, shows a greater preponderance of holdings at the long maturities. So there's been a lengthening of the maturities of the government bond holdings. And here we are indicating these in percentage terms of the total. If we look at the absolute amounts, it turns out that, as you'll see shortly, that the total amount of bond holdings has also increased. Now, why did they lengthen their maturity like this? I think one possible candidate might be the reach for duration. And the reason for thinking that is to think about, and this goes back to the motto of knowing your players, what really motivates some of the market participants. So this is a picture of the duration of assets and duration of liabilities of European insurance companies. And the horizontal axis gives you the duration of the assets, and the vertical axis gives you the duration of liabilities. Therefore, the dotted line, which is the 45-degree line, gives you the set of points where the duration of assets and liabilities exactly match. And you'll notice that most of the dots lie above that line, which is to say the duration of liabilities are longer than the duration of assets. And in particular, you'll see that Germany is particularly, it has a profile which is even more pronounced, even relative to the other countries. Now, this type of behavior where the duration of the asset portfolio is increased turns out to be really quite particular to the insurance sector, and also to the pension fund sector as well. We don't see it in the household sector, or the banking sector, or indeed the investment fund sector. So, for the other sectors in the economy, we don't see the same type of lengthening of duration of the asset portfolio. And the total holdings of the fixed income portfolio has also increased. So here are some numbers that we managed to learn from the data. In Germany, the insurance sector accounts for around 12% of the total holdings of resident bond holdings. But over the year 2014, around 40% of the net purchases of bonds was accounted for by the insurance sector. So there was a much larger increase in the face value of bond holdings by the insurance sector. Now, I mentioned duration matching as one potential channel. The idea is that this is really asset and liability management and trying to minimize interest rate risk, as if you're marking your liabilities to market, and when interest rates fall, your liabilities duration is increasing, and therefore what you want to do is to have your asset duration pretty much match that. And given the duration mismatch, as you saw, the duration of liabilities are longer than the duration of assets. When interest rates fall, the duration of both sides of the balance sheet is increasing. But because the liabilities have a longer duration to begin with, the liabilities duration is running away from you at a much faster pace than the duration of the assets. So if you're attempting to match duration, what you have to do is to go and buy more longer dated bonds in order to even out the scales, so that you can chase the liabilities duration as it's running away from you. But the catch is that the demand for longer dated bonds will succeed only in depressing the yields further, which means that the liabilities duration is running away from you even faster. So this is rather like a dog chasing its tail. The faster you chase your tail, the faster the tail runs away from you. And what we saw in in the last few weeks, of course, is that these things can also very quickly turn on a penny, and just as the long-dated yields are falling and very rapidly, it can also reverse very rapidly and snap back. Now, I think what this episode, and here we need to do further work on exactly what triggered this and what exactly the dynamics were. This is something that we are actually pursuing at the moment with some much more granular data. But it does actually point to the importance of our first research theme and our motto of getting to know your players. We really have to know who the players are, what motivates them. Is it leverage? Is it some other type of constraint? And is the demand curve sloping upwards? Is it sloping downwards? And these are, I think, questions that we need to keep in mind. Now, let me turn to the second research theme, which is on global liquidity and spillovers. And I'd like to describe the role of the role of international currencies, in particular the US dollar. And here the theme is that that spillovers and currencies can be global, even if monetary policy is conducted at a national level. So let me start with this chart, which shows you the dollar denominated cross-border banking sector loans that have been netted within these regions, but gives you these cross-region exposures. And the arrows are in green to indicate that these are US dollar claims. And even in 2002, what you do see already is that the two-way flow between the US and Europe was actually quite significant. And this is accounted for by the flow from the US to Europe of European bank branches in the US raising money market wholesale funding, and then it makes a round trip back to the US through the purchase of US dollar denominated securities that are bought by the European banks. But as we move the clock forward, notice how the arrows become much larger, and look at the numbers. They're becoming very substantial. And this is something that we've now understood much better. It's now much more familiar. And at the just on the eve of the crisis, we see that these arrows had become really very substantial. Notice also how the arrow from Europe to Asia is larger than the arrow from the US to Asia. In other words, even for US dollar intermediation, the amount of dollar intermediation done by the amount of dollar loans made to Asian borrowers by European banks was almost twice the size of the amount that US-based banks were doing towards Asian borrowers. Now, if we compare that to the euro amounts, and the blue arrows here are the euro-denominated cross-border claims. There are some vertices that are actually similar in size. For example, from Europe to Asia is of a comparable size between the euro as compared to the US dollar. But this two-way flow, this round trip from the US to Europe and back again, clearly is nowhere near the same. And here are some of the raw numbers from this kind of exercise. From 2002 to 2007, there was a $3.6 trillion increase in US dollar denominated cross-border border lending. And around 2/3 of this increase, 2.3 trillion, was accounted for by this round trip between Europe and the US. And even if we include the US-based European banks, the banks that were based in the US account for only 35% of the total increase. So the dollar is very much a global currency in this respect. It's the global unit of account for banking. And we've mentioned this, the importance of European banks and intermediating US dollar funds to Asia. Now, what's happened since? Well, after the crisis, what we see is that the two-way flow ebbs and flows depending on what's going on in the world, and you do see the deleveraging that's associated with events in Europe in 2012 and 2014. What we've seen is an increase in the flow from Europe to Asia in US dollar funding. We know from previous work that one of the big themes in banking is the regional integration of Asia, and the fact that Asian banking integration has proceeded at a very rapid pace since the crisis. What these charts show is that Asian integration very much rests on global flows, in particular from Europe back to Asia. Now, what about non-banks? And here, I think we really come right up to date. This is a chart again from the annual report. It shows you the total outstanding amount of US dollar credit to non-banks that are outside of the United States, and the blue areas are the credit in the form of bonds, and the pink is the credit in the form of bank loans. The black line shows you the bank share, and what you see is that the bank share peaked just before the crisis and has subsequently come down, meaning showing very clearly that we're now in the second phase of global liquidity, where it's through the capital markets that we see most of the dollar intermediation happening. What is the equivalent euro amount? Well, it's quite small. It's around a quarter of the size. So this is the chart for the equivalent euro-denominated debt of non-banks outside the euro area. Now, it's true that the growth rates have been quite high in recent months, but to the extent that it's the outstanding stock that should be looked at for vulnerabilities, it's certainly the US dollar that is by far the most important currency in this case. Now, what are the assets that back these liabilities? Because this is the sum of all the borrowings, so the borrowers should have assets that back them. And clearly, many of them will have dollar cash flows. So if you are an exporter or a commodity producer, you will have dollar-denominated cash flows. Some of them will have fewer dollar-denominated cash flows, such as property developers or utilities. But even with those borrowers that have dollar-denominated cash flows, an increase in the value of the dollar may still nevertheless exert some strains on their balance sheet, because we know, for example, that commodity prices are negatively correlated with the dollar. And therefore, in those states of the world where the dollar is strong, commodity cash flows will be weak. And more generally, and let me finish with this, more generally, there is the so-called risk-taking channel, which is really about risk premiums and monetary policy interacting with exchange rates. And here, the intuition is that when the dollar is weak, some borrower balance sheets look very strong. And from the perspective of the lender, credit quality goes up. And for any given exposure limit, you have spare capacity in your lending. You have spare lending capacity, which means that credit supply becomes much more available. But then everything else goes into reverse when the dollar goes up. So when the dollar goes up, those same balance sheets which would have improved with a weaker dollar now actually deteriorates. So some borrowers will have deteriorating balance sheets, which means that from the perspective of the lenders, this represents a deterioration of credit quality. And for any given capacity of lending, you'll need to restrict credit. And therefore, there's a generalized decrease in credit availability. And so what this means is that given the amount of US dollar debt outside the US, it's really the bilateral US dollar exchange rate that matters, not the trade-weighted effective exchange rate. So it's the bilateral US dollar exchange rate which should matter much more for financial conditions than it is for the effective exchange rate. And let me illustrate this with this series of charts. And What this shows is the relationship between the exchange rate, this bilateral exchange rate vis-a-vis the US dollar, and the CDS spread on 5-year local currency sovereign. So these are 5-year local currency sovereign spreads. And these are represented as changes from the end of 2012. Now, if you think about that, if you think about this, this chart, there is really no obvious relationship you should expect between the US dollar bilateral exchange rate on the one hand and sovereign CDS in local currency. And if there are relationships, then they may be quite indirect at first. But and here I've plotted this relationship for a number of emerging markets. These are for Brazil, Indonesia, Mexico, Malaysia, Russia, Turkey, and South Africa. And the size of the bubbles represent the amount of dollar-denominated debt that's accounted by the borrowers in those countries. Now, as we move the clock forward and we reach September 2013, remember this is at the tail end of the taper tantrum, what you see here are the beginnings of a relationship forming where as the bilateral US dollar exchange rate appreciates. So in other words, for these borrowing countries, it's when their currency depreciates vis-a-vis the US dollar. Their sovereign CDS also moves up. Now, when the taper tantrum subsides, and here we're at in the middle of last year, so things quieten down after the taper tantrum, and all the CDS spreads come down. There is still some residual exchange rate movements. Indonesia and South Africa, you'll see, have depreciated most against the US dollar, but Turkey as well. But then we know what happened from the middle of last year, that the US dollar began to appreciate quite strongly. And with that, we had the oil price declining. And as we see that, and as we see the events unfold, we see Russia, Brazil, and Turkey, which is actually an oil importing country, move along this northwest direction. So that by the end of last year, this relationship is now established, I think, quite strongly. Russia, one can argue, is a special case, but see how this relationship is really establishing itself, where the more that you have depreciated against the US dollar, the more it seems that credit conditions are tightening in your country. What happened since last year was, of course, that the oil price began to stabilize, but Brazil and Turkey are now moving very much into that direction. And here is the situation as we are pretty much right now. And you see that the relationship is now pretty firmly established. So this is partly credit risk, but if we think about the risk-taking channel, a lot of it is due to tighter credit conditions. It's really about what the lenders perceive and how market conditions adjust. So all this underscores what the annual report lays out in Chapter 5, which is on the international monetary and financial system. I've mentioned two channels of cross-border spillovers. One is the portfolio choice of investors with global reach. But crucially, there is a role for international currencies over and above simple portfolio choice. And spillbacks, as Jaime indicated, will arise when these accumulated vulnerabilities start to materialize. And when there is an overhang of dollar debts, as there is right now, borrowers who try to repay or reduce their vulnerabilities belatedly will make life harder for other borrowers in the same boat. And this means that growth will suffer if the borrowers are retrenching. And many of these borrowers, as Jaime noted, are corporates, so their investment will suffer. And because many of these corporates are actually publicly owned, the dividends that went to the government to finance fiscal expenditure will also be hit as well. So fiscal positions also tighten. And this slower growth has the potential of spilling back onto the source country as well. So let me finish with the two questions that Jaime ended his presentation with, which is, how far does enlightened self-interest allow many of these spillovers to be internalized? And what additional steps are needed to go from keeping one's own house in order to keeping the neighborhood in order, and indeed keeping the global village in order? So let me finish there.